we're going to transition into a $5 billion market that a lot of advisors don't understand, that it's really a fast growing market within our space. And really the thesis here, right, the sales pitch is, hey, investor, what if you could get above average market returns? You could harvest substantial amount of tax losses, and these tax losses can be used to help offset your gains from your business sale, gains from a real estate sale, even gains from a crypto sale, and keep you very well diversified. So this is what we're calling enhanced direct indexing, and this is kind of a big space that's really blowing up within the advisory world. And so I wanted to make sure we can clearly communicate to some of the trends that we're seeing and why you and I, and eventually we'll talk about this, are actually investing our own money in this, and this is how we're getting our stock market exposure.
Yeah, and I think it's good to take a step back and start with direct indexing, if it's okay if we start there. Direct indexing, which has been around now for a while, and it's got a lot of traction. And I think most brokerage houses and most financial advisors have access to direct indexing. So I'll start first. What's indexing? Indexing is buying things like the S&P 500. You're buying an index, low cost, getting exposure to a certain market. So what is direct indexing? Let me take the S&P 500, for example. If you own the S&P 500 and let's say an ETF, every year, not all the stocks go up and not all the stocks go down. So let's say in a good year, of those 500 stocks, maybe 450 go up, but there's always going to be a few that go down. So let's say 50 go down. In a perfect world, what you would love to do as an investor is hold those 450 so you don't create any gains and just sell the 50 that lost money so you can use those losses to offset other gains in your portfolio. That's the idea. So what they came up with is this direct indexing. So very simple way to think of it is you buy all 500 stocks in the S&P 500, and then you can sell the 50 that went down to create the tax losses, but not sell the 450 that went up. There's one nuance here, and that is, let's say you had Pepsi in your portfolio and you sold it. You can't buy back Pepsi right away for 30 days. It's the wash rule. Instead, you can get similar exposure by buying Coca-Cola. So they would sell, if they sold a company that was down, they would buy a similar or a replacement company in that type of industry so that you keep the same exposure in your index. And that actually has shown to be meaningful in the tax savings when you're building a portfolio. So that's the direct indexing piece. Anything you want to add to that?
No, I think just to put some numbers behind this. So direct indexing is gaining a lot of traction, and it's been growing at 37% per year is some of the data that I've got here over the last 3 years. And interestingly, only 14% of financial advisors, according to one source, are actually actively recommending it. So it's still up and coming, but to your point, it's out there. 86%, I guess, of advisors don't use it or don't understand it. But I think most entrepreneurs who are engaging in our content and that we're talking to have access to it because, to your point, most well-respected large investment management shops have this as an option on their platform. So I love the way you described it. I think now, Jim, go into a little bit more about the enhanced direct indexing, which again is a subsegment of this direct indexing, and break that down.
So enhanced direct indexing, the easiest way to kind of explain it is in a direct indexing scenario, you're going long in all the investments. So you're buying those 500 stocks in the example that I gave. Well, when you're buying 500 stocks and you have your gains and losses, in addition, they short stocks. So the definition of shorting, as you may know if you're listening, is that you're betting against the stock. So when you go long a stock, if it goes up in price, you make money. If it goes down in price, you lose money. If you're shorting a stock, when the price goes up, you lose money. When the price goes down, you actually make money. So they're doing that in a much larger scale, and then they're doing the same thing as direct indexing. They're selling the losers to create the tax losses, and they're holding the winners so that they don't create those gains and create more tax problem for you. In addition, they use leverage at a varying degree depending on the strategist and what they're trying to do. But by using leverage, they're amplifying the losses that they can create to pass on to the investor to offset things like capital gains. So if you think about it, it's taking that direct indexing and just making it much more powerful in its actual execution and how it's working for an investor.
Yep. And I think another word, we were calling this enhanced direct indexing. I've seen other people call this leveraged long short funds, but these are separately managed accounts that, to your point, are adding on these extra bells and whistles. Now, why are these bells and whistles important? Now, historically, really based off of the last several years, these funds have really outperformed their benchmarks, whether it's the Russell 1000 or Russell 3000. But on top of that, we've seen the tax losses that can be generated span from 30 to like 95% within the first 12 months. Meaning you put $1 million in, hypothetically, you could get capital gain or capital losses, I should say, worth 320 grand up to 940 grand, depending on how much leverage you're willing to take on. So again, the tax losses could be very substantial, but most importantly, the performance been very, very strong as we've looked at these over the last several years.
Yeah, that's one important point is that these are strategies where you're trying to make money or actually trying to outperform markets. This is not just a tax play. You want to outperform, you want to make money, and oh, by the way, there are tax benefits that get generated from these strategies.
Yep, and I think it's very important to note that the losses that are spit off here are capital losses. So capital losses can be used to offset other capital gains, whether short-term or long-term capital gains. Those are derived when you sell your business, you sell real estate, you sell a stock, when you sell crypto. Those are capital losses. These losses cannot offset your business income. They cannot offset W-2. Technically, you can offset $3,000 a year, but that's a rounding error. So that's really important to note because as we talk through these with entrepreneurs and with our investors, it's making sure that they're really educated on like what losses can this actually offset. Because if you don't have this type of income, then the value from a tax perspective isn't as valuable. Now, there's still great value from a performance perspective because they've performed so well. But again, from a tax perspective, it's really important that we're matching up the type of income we have and then trying to match it with other losses of that same exact type to offset
I want to
it.
double down on that because it's something that entrepreneurs miss a lot. And you've done a good job just in our private conversations talking about this is when you're doing a tax plan, the first thing you have to decide is what are you trying to offset? What is your tax issue? Not just throwing, shotgunning the thing, but figuring out, do you have portfolio income you need offset? Do you have passive income that you need offset? Do you have active income that you need offset? That's going to dictate what strategies or tactics that you might want to consider based on your situation. And often entrepreneurs think, well, my buddy's doing this, that, and the other, so I should do the same. Well, it depends. You might not be trying to solve the same problem.
Yep, totally agree. So who's a good fit here? So if you're an entrepreneur and you are expecting a liquidity event, whether a business sale, an ESOP, maybe you want to rebalance your crypto portfolio and you have a lot of unrealized gains. Maybe you don't want to do the 1031, the buy, borrow, die strategy we talked on the last podcast, and you want to instead, recapitalize your balance sheet. Well, that's where these investments could make a lot of sense. It gets you exposure to the stock market as the underlying asset class. It's performed very well historically. And on top of that, you can accumulate a lot of losses. Now, if you don't use those losses in that year, they do roll forward. So you carry these losses on your tax return until you have that capital gain event. So that's why we're seeing these used strategically to pad losses ahead of a liquidity event that we're forecasting in the future.
That's so smart. And it's something that a lot of entrepreneurs don't think about. And I can't tell you how many times I've been speaking at an event and an entrepreneur runs up to me and says, hey, I just got an LOI. I need your help. And I always think, 3 to 5 years before an exit is when you really start wanting to think about your exit and how to plan for it. And most entrepreneurs who've had more than one exit, they always say my first exit, I was so dumb. I did everything wrong. I didn't do anything. And then they learn and then they realize that pre-planning prevents those problems.